Somewhere right now, a landlord is collecting £1,200 a month in rent on a flat with an £1,100 mortgage payment. £100 of profit, that's it. If you did the math, you'd probably think, that's a terrible business. You'd make more stacking shelves. And yet, property is still the single most common way ordinary people build serious wealth. Not the flashiest way, not the fastest, but statistically, one of the most reliable. So here's the mystery. If the monthly numbers look this thin, where is the money actually coming from? Because it's clearly not the £100. That's what we're going to trace today, pound by pound, through an ordinary rental property, until we find where the real profit is hiding. If you want to understand how ordinary financial decisions like buying a house actually turn into wealth, and how to spot the difference between a good deal and a trap, subscribe to the channel. That's the entire point of what we do here, following the money until it makes sense. Let's start with the version of real estate most people actually encounter, not a property mogul with 40 units, just one person buying one flat to rent out. Say they buy it for £200,000. They put down £40,000 and borrow the rest, £160,000, from a bank. They rent it out for £1,200 a month. The mortgage costs £1,100 a month. On paper, that's £100 a month in cash left over, £1,200 a year. If that's genuinely all that's happening, the landlord has tied up £40,000 of their own money to earn £1,200 a year. That's a 3% return. You could get close to that in a savings account without fixing a single boiler. So why do it? This is the question almost nobody asks out loud, and it's the one that unlocks the entire industry. Let's actually follow the £1,200 in monthly rent, because profit is £100 is too simple to be true. There are costs hiding in that number that never show up in the headline math. Illustrative example. Figures will vary by property and location. £1,200 rent collected minus £1,100. Mortgage payment minus £60. Maintenance and repairs averaged monthly minus £40. Insurance minus £30. Letting agent management fee minus 20 void periods averaged. The weeks the flat sits empty between tenants. Add that up and the £100 profit is often already gone. Sometimes it's negative some months. Here's the part most first-time landlords don't see coming. A boiler breakdown, a leaking roof, or a tenant who stops paying can wipe out an entire year of that thin monthly margin in a single event. So if the monthly cash flow is this fragile and sometimes barely breaks even, why does anyone do this? You might assume the money in real estate comes from rent. That's the assumption almost everyone starts with, because it's the part you can see and measure every month. But rental income was never the main event. It's closer to a supporting cast member. Here's the mechanism most people miss. That mortgage payment of £1,100 a month isn't just an expense. Part of it is paying down the loan itself. Every month, the landlord owns a slightly bigger slice of a £200,000 asset, and the tenant's rent is the one paying for it. Illustratively, in the early years of a mortgage, maybe £300 of that £1,100 payment is going toward the loan balance, not just interest. That's £300 a month, roughly £3,600 a year, quietly building equity, invisible in the cash flow number, but very real on the balance sheet. Suddenly the picture changes. It's not £100 profit a month, it's £100 in cash, plus roughly £300 in debt paid off by somebody else's money. That's the part that never shows up when people complain that rental yields look small. And this is where things get interesting. because that's still not the biggest piece. You might think the biggest source of real estate wealth is rent, or even the debt paydown we just uncovered. But historically, in most markets, the largest single driver has been something else entirely: the value of the property itself going up. If that £200,000 flat appreciates by just 3% a year, a modest, unremarkable assumption, not a boom, that's £6,000 in a single year. On a £40,000 deposit, that's a 15% return before you've even counted the rent or the debt paydown. This is where the concept that makes real estate different from almost every other small business enters the picture: leverage. The landlord only put in £40,000, but they're earning appreciation on the entire £200,000 asset because the bank's £160,000 is working for them too. If the property rises 3%, the landlord isn't earning 3% on their money. They're earning something closer to 15% because they only paid for a fifth of the asset. This is the part that breaks most people's mental model of the deal. They think, I'm risking £40,000 to make £1,200 a year. What's actually happening is, I'm controlling a £200,000 asset with £40,000, and I benefit from 100% of its growth. That's not a rental business. That's a leveraged investment wearing a landlord costume. So now we have three separate profit streams stacked on top of each other. 1. Cash flow, thin, sometimes close to zero, occasionally negative. 2. Debt paydown, the tenant slowly buying the property for the owner. 3. Appreciation, leveraged growth on the full asset value, not just the deposit. Individually, none of these looks dramatic. Combined, they explain why a £100 a month property can genuinely build six-figure wealth over a decade. Here's a simple illustrative comparison. Over 10 years, on that same flat, cash flow, roughly £12,000 total, illustrative, assuming no major repairs. Debt paid down, illustratively £45,000, £50,000 as the mortgage balance shrinks. Appreciation at a conservative 3% a year. The property could be worth roughly £269,000, a gain of about £69,000. Added together, that's well over £120,000 of wealth built from a £40,000 deposit, while the monthly profit looked almost embarrassing the entire time. This is the real profit engine of ordinary residential real estate. Using someone else's money, the banks, and effectively the tenants, to control an appreciating asset and letting time do the heavy lifting. It's not that landlords are secretly geniuses, it's that the structure of the deal quietly multiplies small numbers into large ones, the same way £2 saved on 1,000 transactions becomes £2,000. Except here, the multiplier isn't volume, it's leverage and time. Think about your own life for a second. Have you ever looked at your mortgage statement and only seen the total amount going out, without noticing how much of it was actually paying you back, in the form of equity? If you've never really looked at it that way, you're not alone. Most people don't. And that's exactly the kind of thing we break down here. So if that's useful, subscribe. Now, before this starts to sound like a guaranteed formula, here's the part most property content conveniently skips. Leverage cuts both ways. If a 3% rise in property value turns a £40,000 deposit into a 15% gain, a 3% fall does the same thing in reverse, except worse, because the debt doesn't shrink just because the asset's value did. The landlord still owes the bank £160,000, whether the flat is worth £200,000 or £180,000. And this is where the fragile cash flow from Act 2 becomes dangerous, not just annoying. If interest rates rise, that £1,100 mortgage payment can climb to £1,300 or £1,400 almost overnight when a fixed rate ends, while rent takes months, sometimes years, to catch up. Suddenly, the £100 profit isn't thin. It's gone, and the landlord is paying to hold the asset every single month. Add a tenant who stops paying, a void period that runs long, or an unexpected repair, a new roof, a failed damp course, and a property that looked like a wealth machine on paper can turn into a monthly financial drain that lasts for years. This is the risk that quietly ends a lot of amateur landlords. Not a lack of ambition, but a lack of cash buffer. They calculated the upside beautifully and never stress-tested the downside. So what do experienced property investors actually do differently from the person who buys one flat and hopes for the best? A few consistent patterns show up again and again. They price in the bad months, not just the good ones. Instead of calculating profit, assuming full occupancy and no repairs, experienced landlords build in a buffer, often treating 1 month's rent a year as gone before they even start, to cover voids and maintenance. They separate the property from the person. Many hold properties through a limited company structure, which changes how profits, debt, and tax are treated, reducing their personal exposure if something goes wrong. They focus on cash flow positive deals from day one, not appreciation hope. Rather than buying anything and waiting for the market to rise, disciplined investors look for property where the rent comfortably covers costs before counting on appreciation at all, treating growth as a bonus, not the plan. They think in portfolios, not single units. One property depending on one tenant is fragile. 5 smaller properties across different tenants spread the risk. If one is empty, the other 4 are still generating income. The lesson underneath all of this: the property itself isn't what makes the difference. The structure around it, the buffer, the legal setup, the underwriting discipline, is what separates a hobby that occasionally goes wrong from a business that compounds reliably. Here's the shift in thinking that actually matters, and it applies far beyond property. Most people ask, should I buy a rental property? That's the wrong first question, because it skips straight to the biggest, riskiest version of the idea. The better question is there a smaller, safer way to apply the same principle, using leverage and time to grow an asset, without betting everything on one deal? That could mean starting with a property in a lower price bracket where the numbers are more forgiving and mistakes are cheaper. House hacking, living in one part of a property while renting out the rest, so the tenant's rent covers most or all of the mortgage from day one. Partnering with someone else to split the deposit and the risk on a first deal, rather than stretching alone. Renting out a spare room or existing space before ever taking on a mortgage at all, to understand the realities of being a landlord with far less at stake. None of these promise instant wealth. What they do is let an ordinary person test the mechanics, leverage, tenants, maintenance, cash flow, before committing life-changing amounts of money to it. The principle isn't buy property. The principle is find an appreciating asset you can control with borrowed money, where someone else's payments cover the cost of holding it, and give it time. Property is simply the most common vehicle for that idea, not the only one. So let's answer the question we opened with. If the monthly numbers are this thin, where does the real money come from? The real estate business was never really about renting out a flat for £1,200 a month. That's just the visible transaction, the one number everyone can see and argue about. The actual business is this: borrow money to control an asset that tends to rise in value over time, and get someone else, the tenant, to make the payments on that borrowed money for you. The rent isn't the profit, the rent is the fuel. That keeps the real profit engine, leverage and time, running without the owner having to feed it cash every month. That's the sentence that changes how you look at every landlord you've ever met. They're not really running a rental business. They're running a debt-financed, tenant-subsidized appreciation strategy, and the for rent sign out front is just the mechanism that makes it self-funding. Remember that flat from the beginning. £1,200 a month in rent, £1,100 mortgage, £100 left over, a number that looked almost pointless. Now you know what was actually happening behind that £100. Part of the mortgage payment was buying the owner a bigger slice of a £200,000 asset. The asset itself was likely growing in value on the entire £200,000, not just the $40,000 the owner put in, and the tenant's rent was covering nearly all of it. £1,000 a month was never the point. It was the visible tip of a much larger, much slower machine, one built on debt, discipline, and time, not on rent alone. If there's one thing to take from this, it's to stop asking, what's the monthly profit, as if that's the whole story, for property or for any asset-based business. Instead, 1. Know what's really being paid for. Some of every payment might be building an asset, not just covering a cost. 2. Understand leverage before you use it. Borrowed money can multiply gains and losses far faster than cash alone. 3. Never judge a deal on one number. Cash flow, debt paydown, and appreciation all matter. Looking at only one gives a distorted picture. 4. Build in a buffer for the bad months, not just the good ones. That's what separates a resilient investor from a fragile one. 5. Start smaller than your ambition wants to. Test the mechanics before you scale the risk. If this changed the way you'll look at that £100 a month property, next time someone mentions it, subscribe. Because on this channel, we're not just talking about business ideas. We're following the money until the real story shows up, so you can spot it yourself, in real estate or anywhere else. The next time someone tells you real estate made them rich, don't ask how much rent they collected. Ask how long they held on, because that's where the real money was always hiding.